The stock market is tanking, but are you about to make the biggest mistake that could wreck your retirement? Well, in our financial freedom video today, we're going to be talking about what you should do. And just as importantly, we're going to be talking about what you should not do based on where you are in your retirement journey. So stay locked in. Hi, my name is Carson Graves, certified financial planner and president and CEO of the Retirement Education Center.
And my name is Andrea Graves, Director of Operations at the Retirement Education Center. For additional concepts on how to maximize your retirement, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos. We want to welcome you back to our channel. Well, Carson, with markets selling off and fear creeping in, the real question people may be asking is how should they respond, especially if they're nearing, entering, or already in retirement?
Well, Andrea, these are very important questions during these times that people definitely should be asking themselves. But the truth is that your response shouldn't be driven by any headlines or emotions, but it should be based on your unique stage of where you are in your retirement journey. What may work for someone in their 30s or 40s right now could be a disaster for someone who's already in retirement and they're drawing their income. So anytime there's a major market decline, before you make any knee-jerk decisions, it is important for you to understand what to do, but of course what not to do during these times. And that's what we're going to be covering in our financial freedom video today. But before we get into that, there are always two rules to retirement income that we like to give you. And Andrew, what are those two rules?
Well, rule number one is to never run out of money, and rule number two is to never forget rule number one.
Okay, so let's go ahead and jump into our lesson today to talk about what you should do, but just as importantly, what you should not be doing in a major stock market decline.
All right, Carson. So when the markets are dropping, why is it so important to make decisions based on where you are in your retirement journey?
Well, it's a very good question, and this is why we're doing this video. It matters most when the market is dropping that you really focus on where you are in your retirement journey. For instance, if you're younger, Andrea, and you're just starting out and you're saving money and you have time on your side, if the market is actually going down, this can be seen as a buying opportunity. A lot of times you'll hear people talking about buying the quote unquote dip. So when you are younger in your retirement journey, volatility really becomes just part of the ride. I would normally encourage any of my younger clients that when the market does drop, they see it as a discount, just like they would if they were going into a department store, Andrea, and then try to buy things in their retirement accounts cheaper than what they would when the markets are higher. But of course, on the flip side of this, if you're actually near retirement or you're already in retirement, things change drastically of how you should approach a market downturn. At this stage of retirement, you're really no longer focusing on growth, but you're really talking about income and asset preservation at this time. And one of the main things that you have to really think about, especially early in your retirement, is a little known risk known as sequence of returns risk. And this risk is really dangerous if you don't understand it, because if you end up having a major market downturn early on in your retirement and you're having to extract funds from your retirement portfolio, it can actually hurt the long-term sustainability of your retirement savings. But that is why it is always recommended that you have a plan in place that's really going to be tailored to your time horizon and your risk tolerance. Now, let's go ahead and transition over to our teaching slides so we can take a deeper dive into this topic. And as always, make sure you do stick around to the end, because I am going to give you a very powerful moral of this story that you must take heed to, because it's going to summarize this information very well. So let's go ahead and talk about what the recent historical market drops have meant. Over the last 43 years, this is a study between 1980 and 2023, the average intraday drop in the S&P 500 has been about 14.2%. But you have to also understand that in 32 of those 43 years, the market still ended up the year in the positive area. So even though there's been drops on average of 14.2% within the year, 32 of the 43 years during that time frame, the market still ended up positive. And here's the detriment to most people when the markets start dropping. It's about missing the best days of the market, trying to time the market. So between 2003 and 2023, if you had stayed fully invested in the market, you would have had an annualized return of 9.8%. Yet if you only missed 10 of the best days during that time frame, your annualized return would have been cut in half at 5.6%. If you had missed 20 of the best days, it gets even more dramatic. You're down to a 2.9% annualized return. This illustrates just how important it is for individuals when the market is changing or dropping dramatically to try to stay the course. One of the best things that you can do in order to stay the course when the market is dropping is to make sure that you have a plan. A plan changes everything in a volatile market. Here's why. When you have a plan, it has been noted that investors with a plan are more confident and they're more successful. As a matter of fact, Charles Schwab did a recent study that showed that 65% of investors with a written financial plan, they feel more financially stable versus just 40% of people who do not have one. Another major element of having a retirement plan is that it keeps you from buying high and selling low. This is the cardinal sin of investing. Over the last 20 years, various studies have shown that the average investor has earned just 6.81% trying to do things on their own and not having a plan, while the S&P 500 has returned 9.76% during that time frame. Why is the average investor typically underperforming the market? Basically, it's because of poor timing decisions. You're trying to time the market. It's not good. People do panic selling, and they also have the fear of missing out. They're wondering if that Bitcoin is going to go to the moon or not. You have to stay put and you have to have a plan if you want to make sure that you're being efficient during the market downturn. When you have a plan, you're going to understand your goals, you're going to understand your timeline, and that plan is going to be catered to your risk tolerance as well. The plan also helps you to rebalance and not react to a market downturn. And this example is not to give any financial advice because we're not giving that on this channel, but I want to bring out a point here. Let's just say that your portfolio has a targeted range of 60% stocks and 40% bonds. This is very common. Well, let's just say we do have a major market drop like we've recently seen, and it brings that mix down to a 50-50 in your portfolio. A plan is going to tell you to rebalance and make that a buying opportunity for that portfolio while they are low. Another reason why you want to sit down with a certified financial planner in your area and develop a plan for your retirement is because a plan is going to give you a peace of mind during a crisis. So let's go ahead again and take a look at some historical data to bring this to life. During COVID, March of 2020, the S&P 500 fell literally 34% in just a few weeks, but recovered fully within 5 months. Of course, many of us remember 2008 during the housing crisis when the market lost trillions of dollars. It took literally 4.5 years to fully recover, but those who did stay in the market had over a 400% increase in their portfolio between 2009 and 2022.
All right, Carson, so what's the moral of this video?
Well, quite frankly, Andrea, the moral of this video is that when it comes to a major stock market crash, panic is not a plan. But the greatest asset that you can literally have during a market crash is a retirement plan, because that's going to keep you calm and stop you from making knee-jerk decisions, which can ultimately interrupt your entire retirement solvency for the long term. And as always, be sure that you speak to a certified financial planner in your area who can help you with these types of decisions.
After this video, please check out our other videos that will give you tips on how to maximize your retirement. And if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers. Please note that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for an independent fiduciary advisor to help you with these types of complex financial matters, we highly recommend that you utilize the links in our description below and go ahead and schedule a 1-hour free consultation with us today.